We are going to continue this conversation about the debt deadline. That August 2nd date is looming. Now, if you hold treasuries, what should you do? Well, our next guest says a default would not be as bad as a credit downgrade. Krishna Memani is with us now. He is the director of fixed income at Oppenheimer Funds. He oversees $70 billion. Krishna, thanks so much for joining Adam and I this morning in the newsroom. Glad to have you with us.
Pleasure.
What is the most prudent course of action at this point, going into the weekend and knowing that that debt was delayed yesterday?
The most prudent course of action for the politicians, of course, is to pass something. The world would be thrilled if they did something along those lines. As far as investors are concerned, I think the point I would make is that we still have time. And even after the August 2nd deadline, it's not clear that on that particular day something terrible would happen. So there are...
It's a self-imposed deadline.
It's a self-imposed deadline. The Treasury has some flexibility to postpone the actual date of default if there is going to be one. I think in the interim, politicians would probably find something to resolve this issue.
But you don't think that the Treasury market, for example, would just sell off?
I don't think so. I think the Treasury market basically is, the base case is still for them to find some sort of a resolution. The longer it takes, there's going to be more volatility. But it isn't clear to me that if there is a default imminent, that treasuries would actually rise in yield, because it's really the economy that's a big issue. And in that case, people from the equity markets would be looking to get out of those markets and trying to get to safe harbor, and treasuries may provide that safe harbor.
Well, and ironically, even this morning, as we look at where the 10-year is trading, it's trading up. It's a 291 yield. In other words, people are buying treasuries even this morning on the heels of a failed vote.
Yes. Again, the fact that the Treasury may default because of some political issues and such concerns, as opposed to their ability to pay, we think it's not clear to us that the Treasuries are going to actually sell off. In that environment, we think the likelihood of Treasury yields falling substantially is probably higher than yields rising substantially.
And then begs the question that if we do miss that August 2nd deadline, then do the ratings agencies react right away and downgrade the U.S., which you do say would be damaging to Treasury holders?
Yeah, I think a default is a temporary phenomenon. Eventually, it would be cured in some way. A downgrade is very profound in that the likelihood that they will upgrade us back to AAA anytime soon, given the direction of the deficits, is pretty small.
And, well...
The point I'm trying to make is if a downgrade happens, it wouldn't be catastrophic, but it really would be hurtful for the economy and funding costs for basically every borrower in the world.
And bingo, that's exactly what you just said, funding costs. Have you modeled what it might do to our funding costs?
Well, again, you can't really model the funding costs in isolation because it will really depend on what's going on in the economy. So everything else being equal, the fact that the U.S. Is a AA issuer as opposed to a AAA issuer would probably lead to a modest increase in funding costs. But I think it would be very detrimental for the economy, and that's really the big issue we ought to focus on.
Especially this week, we saw that durable goods data come in much weaker, so there's a lot of concern anyway about where the economy is going. Krishna,
GDP today.
GDP today, a lot to check in with. Krishna, thanks so much. Krishna Memani joining us there. He's director of fixed income at Oppenheimer Funds. Well, when we come